Good afternoon, everyone. Welcome to the Q3 Freight Plus Transportation Market Update. My name is Tanner Dehart. I am on the customer success team here at Freight Plus, joined alongside good friend Mike Beckwith from Freight Plus as well. For those of you that might be new to Freight Plus is a transportation management organization who specializes in finding efficiencies and identifying cost savings within shippers' supply chains. Mike, how are you doing today?
Doing great, Tanner. Thanks for having me.
Yeah, absolutely. Well, thanks for joining us, guys. We have some really exciting data here to walk through. We want to give you an update on what we're seeing in the marketplace moving through the back half of 2024. What you can expect not only from a transportation side of things, but also from an economical standpoint. But want to start, Mike, with just kind of quickly getting your thoughts on what are we seeing and what are you expecting on the back half of 2024?
Yeah, it's a good question, right? I think it's how you ask the question that's important as well. If you were to ask me what my outlook on demand is, not very bullish, right? We are seeing rising import levels. We're starting to see inventory levels start to dip a little bit, but we're not. What we're not seeing is industrial production, which is very important to the health of the truckload industry. But if you were to ask me if I'm bullish on rates rising, absolutely. Based on what we've seen historically with how rates interact with changing supply and demand, we are definitely at the position where we're going to start to see rates rise again year over year, at least for the spot market.
Yeah, absolutely. Great take. And if you kind of had to choose between the two, what do you think has a bigger impact in the next market cycle? Do you think it's more of what's happening in the economy with jobs and interest rates and inflation, or do you think it has to more do with the capacity side of things, with the amount of carriers that are in the market?
Right now, I'd say it's been more affected by the carrier community, right? We've seen rates really hit the bottom for the past several quarters here, and the health of the capital of actual carriers and in brokers as well has been stretched pretty far. And we've started to see carriers continue to leave the market for an extended period of time, longer than what we've seen in previous cycles before, which is continuing to set the stage of that imbalance of supply and demand.
Absolutely. And we actually have a few charts to get into some of that data. So let's break it down. Let's go ahead and bring up the presentation that we have. First one is everyone's pretty much aware of what's going on with personal consumption as well as inflation, right? So the Fed is getting closer and closer to that 2% inflation mark, where they were going to feel comfortable to start easing a little bit on the economy and think about starting to lower rates. Mike, we're at 2.5%. We're not quite down to the Fed's target yet, but it sounds like they're getting pretty close to start cutting rates. What are your thoughts on this?
Yeah, as Jerome Powell's already mentioned to the press, the time has come for policy adjustment. The upside to risk of inflation has diminished, but the downside of risks of employment have increased. So, as expected, finally we're here. We should see interest rates drop here on the 18th when Jerome Powell gives his next press conference. And the reason why
Absolutely.
that's important, right? Not to cut you off there, but
You're good.
want to understand how it affects the industry, right?
Mhm.
When interest rates are lowered, we should see more investment back into inventory levels as capital becomes a little bit more cheap for industry. The other side of it is the consumer, right? The consumer, as well as we've seen housing data drop. We've seen less purchasing take place while debts have been rising at the same time, right? That interest rate being dropped is going to allow for the consumer to be even more resilient than we've already seen in these last quarters.
Absolutely. And if you're a shipper and you're thinking about not just the back half of 2024, but if I'm a shipper looking at 2025, looking at the transportation market, maybe I've got an RFP coming up in the next few months or towards the end of the year, how should I be thinking about inflation from a shipper standpoint when it comes to locking in truckload rates?
Yeah, so inflation in actual products is very much so different than the inflation that we see in the trucking market. Now, don't get me wrong, if you were to align the two graphs together, during COVID, we saw, inflation in both transportation costs and in actual commodities being produced. But what's unique to the current situation is you're still seeing inflation that's going to be above 0%. I mean, that's never going away for the U.S. economy. But what we do see is periods of deflation in the transportation market, which is what we're currently exiting. We do expect that the rate of inflation to change, which we'll talk about later, during our time together here. But we will expect to see that inflation take place from actual transportation costs.
Absolutely, and I think you bring up a really good point. Is a lot of people say I've heard is that, oh, well, inflation's coming down, or prices are coming down or starting to, and it's, well, no, not necessarily, right? It's just the rate at which prices are going up is just slowing. Prices
Right.
are still increasing, from everything from new cars to produce at the grocery store, all across the board. Prices have still continued to climb. It's just the rate at which they are growing has slowed.
Absolutely.
Uh, which moves us into the next piece of data I want to look at, Mike, which is how much money are people actually spending. So the two pieces of data we have up here on the presentation, the one on the left is total consumer credit outstanding. So this is all loans, including credit cards, car loans, business loans, student loan debt. This is everything. And then on the right hand side is just revolving, right? So revolving is credit cards. So total debt on the left, credit card debt on the right. And Mike, the looking at the first piece is the just the total amount of debt that is outstanding. It continues to climb. That's concerning.
Yeah, absolutely. And you'll see in a graph coming up here as well, the consumer behavior really hasn't changed. Even with interest rate rising, even with everything that they've been faced with from an economic standpoint at the individual level, they haven't changed their behavior. And as a result, you're seeing those credit limits continue to be exceeded, and that outstanding credit continue to rise, month over month.
Yeah, and I to your point, I think the U.S. American consumer is way more resilient than I think a lot of people think. Right? There's been rumors of, oh, we were in a kind of a tiny recession at the back half of COVID, or we should be in a recession already. Why is it not here? And people stockpiled a lot of cash during COVID because they were concerned. And I think wage growth has continued to increase. Yes, the rate at which rate growth has slowed, but people are continuing to find new jobs, make more money. They're saving money, so they're continuing to spend money. I actually saw this morning that new car sales were actually up almost 3% year over year, from July of 23 to July of 24. So people are going out, they're still buying new cars, interest rates are still high, and it just doesn't seem that has any room to slow down soon.
Yeah, absolutely.
And then, of course, on the right, one thing that is interesting is it actually has looked like credit card debt has kind of maybe found a peak. One thing I read as well this week is that delinquency rates are starting to climb, specifically in the small business segment. So that is usually a concern when it comes time for a recession, or how are the small local businesses doing? Are they starting to get behind on payments? Are they going delinquent? And it seems that at least the credit card piece has seemed to find its peak.
Yeah, absolutely. I mean, and the Fed has said as much, right? It's time for a policy adjustment. It's time to lower interest rates for the health of the economy at this point.
Sure. Uh, Leading into that is how many people are working, right? And so looking at the continued unemployment claims week over week, uh, obviously to 2022, 2023 into 24, it looks fairly flat. In our opinion, in my opinion, I think the unemployment rate is still at a manageable level, right? We're 4.3. It just got adjusted from 4.2 to 4.3. So a 4 to 5% unemployment rate in our nation is still fairly healthy, right? I think when you start getting up to 6, 7, 8% is definitely actual signs of a recession. The most previous recession during 2008, we got up to about 10% total unemployment in the United States. But again, we're still around low fours. Mike, where do you possibly see unemployment climbing to the back half of 2024?
Yeah, I mean, again, with the Fed doing a policy change, we should see a little bit of a reversal of where we're currently trending. I know that graph looks like it's been relatively flat since the back half of 21, but in reality, it's been slowly climbing and climbing and climbing, just little by little. And while we're still hovering around that 4% number, we're starting to see more and more unemployment claims come in. While it's not a rapid rate of increases, it's still steadily rising, and then that's another metric that, of course, the Fed's looking at in terms of that policy adjustment.
Absolutely. I believe the new jobs creation just came out this morning. Again, for this, I think the 17th month in a row or 20th, we're getting up there where it's continuing to be under expectations. I think it was 99,000 jobs created compared to an estimated 144. So it continues to be under expectations for new jobs created as well coming into the marketplace.
Yep.
So let's take that payroll. How many people are working? Looking at how many people are in the transportation space. Mike, this is a chart you created looking at the transportation payroll compared to the Class 8 truckload orders. Walk us through this a little bit.
Yeah, so this is really to represent the health of the supply side of the transportation market, right? So you usually see in years where rates are rising, you'll see that Class 8 truck purchase order start to increase in relation to inflating costs, right? More revenue per truck means more revenue for the business, which means more investment dollars to go continue to invest in new capacity and expanding your fleets. As we've seen in this current freight recession that we've been in for several quarters now, Class 8 truck purchase orders haven't really changed. They've been either down or relatively flat in comparison to previous years. The reason why I take the payroll data for the transportation industry, and just to clarify there, we're not just looking at truck drivers, we're looking at dispatchers, warehousing, dock workers. I mean, everybody in a transportation type role in the US economy, that's been decreasing as demands decrease. Obviously, the payroll, or at least the amount of employees required to move said demand, has decreased in relation as well. So it kind of gives you an idea of where the market directionally has been going these past couple quarters since we've seen rates fall out.
Yeah, and one point that's really interesting here, zooming in on the chart, the truck transportation payroll piece is the rate at which it's declining is quite low, and that's the reason that I feel like the market, specifically the transportation market, in regards to rates and capacity, has not flipped yet, is because we are still way oversupplied in the market when it comes to the amount of trucking companies and the amount of drivers on the road. Right, we're only losing close to 2% right now. That really needs to, the acceleration of that decline really needs to speed up to make a meaningful impact in the back half of the transportation market. Yes, week over week, more and more trucking companies are leaving the marketplace, but the rate at which they are leaving is very slow at the moment.
Yeah, and if you don't mind going to the next graph, I'll kind of talk to that point too. What has been unique to this current condition, or at least this current freight recession, is the COVID loans, right? COVID loans were taken out for small businesses, and if you're an owner operator or a small fleet size, you qualify as a small business, right? So you saw a lot of these COVID loans being taken. That has really helped to bolster up their capital and really hold on tight through this freight recession to keep capacity in the market. But at the end of the day, we're still seeing capacity leave as these COVID loans are starting to get called for repayment.
Absolutely. And there was a little bit of acceleration late 2023. I mean, we were to a point where we're 1,000, 1,200, 1,500, almost 2,000. You can see there's a few weeks there. So I think maybe those are some outliers. But yes, this needs to accelerate in order to make a really meaningful impact. Obviously, there was hundreds of thousands of carriers that came into the market during COVID. A lot of those guys were 1 to 5 trucks, right? Small owner operators. Those guys don't necessarily leave the market, right? They just kind of either sell their truck and go drive for a large trucking company, so they're not necessarily leaving the industry, but the actual amount of registered carriers is continuing to shrink. So again, I think if we do fall into a recession, there continues to be contracted freight. I do think we'll see more small carriers exit the market at a more accelerated rate, and I think overall the capacity impact is what has the largest impact on the next market cycle. Which moves us into demand, right? So we've talked about supply, we've kind of talked about the economy. Let's look at the demand side, right? So how much is actually coming into our country from a inbound ocean TEU perspective? So TEU, for anybody that's unfamiliar, just stands for 20-foot equivalent, right? So it's just a sea box. So how many boxes on ships are leaving China and coming into the United States? As we know, that is our largest import shipping lane that we receive. And so this is looking at basically the last 5 years, right? So you can see the different colors coordinate with 2020 through year to date so far. The green line is 2024. You can see it's basically up to August. So as of yesterday, when we took this screenshot, Mike, this year so far is looking pretty strong from an import standpoint.
Yeah, in terms of imports, you're definitely seeing increases over 2020 and 2023. But what you are ultimately seeing is really that same amount almost as we saw in 2021 and 2022. So, in terms of direct TEU imports for us, we're not seeing any dramatic change there. But what we are seeing is some changing behavior when it comes to the way that trade routes are ran, especially as we look at tariff issues that we're running into with China right now. We're seeing a lot of the way that China is importing is changing just to get around those tariffs. Using Mexico, for example, to avoid some of that, some of those costs.
Yeah. So you think that one of the biggest reasons behind the behavioral changes in regards to tariff, do you think that a lot of people are maybe pulling ahead or maybe ordering inventory earlier in fear of increased tariffs?
Yeah, I mean, I think that's definitely going to be a part of it, right? You naturally see imports rise as we get in more into the peak season, holiday shipping times, anyways. But yeah, absolutely. Like dependent on who's going to be our next president of the U.S. is definitely a big question mark for some shippers or suppliers pushing stuff into the U.S. market. And there's obviously going to be some fear there that is going to play into that behavior.
Absolutely. And not only, of course, do we receive imports into the United States from China, but also want to take a look at the amount of volume that's coming into Mexico from China as well. Mexico is obviously our southern neighboring partner. The amount of truckload volume that crosses the border continues to climb. So looking at also the imports into Mexico, I think is very important. And this looks to be at a 5-year high, Mike.
Yeah, I mean, absolutely. And that's kind of what I was speaking to. You look at imports into the U.S., you're not seeing a ton of movement, maybe 5% growth year over year, which is expected from 23. But what is unique this year is the amount of data that we're seeing from China into Mexico, right? Again, a lot of it is trying to avoid those tariffs, bringing it to another country of origin for, manufacturing to take place, that nearshoring strategy, and then trucking it up from Mexico up through the U.S., which you'll see actually in the next slide, I believe.
Yeah, absolutely. And I totally agree with you. I think nearshoring has had a much larger impact on our economy than some people have thought. Looking at some of the actual products that have been imported, right? So not only do we have access to the amount of imports, but we can see what's actually on those containers, and it's such things such as computer parts, right? Electric parts, batteries, lithium batteries for EVs, right? Plastics. So everything raw material for manufacturing. And what I think is happening is United States companies continue to build manufacturing facilities in Mexico, right? Because land is cheap, labor is cheaper in Mexico. They're building it down there, they're sourcing it, and then trucking it up to the United States. So again, I think continuing to look at how many imports are coming into Mexico is going to continue to be a vital piece of data, kind of putting it alongside the imports for the United States. Now, leading us into the next slide here, this is the how many crossings from Mexico to the U.S. are happening on a monthly basis. And Mike, walk us through this one.
Yeah, I mean, again, as we pointed out in the last slide, with more imports from China coming in, obviously the next direct result of that is seeing more crossings happen from Mexico. And we've seen this steadily change, year over year. We're seeing more and more trucks being crossed over as company strategies, again, is that near shoring. But, the one thing that we're looking at right now is just more congestion happening at the southern borders when we're looking at that increasing in demand that's now taking place coming in from Mexico.
Absolutely. And I expected this chart to continue to climb over the next decade. We've heard from large corporations that they're going to continue to build facilities in Mexico, move operations to Mexico, just due to the costs, right? Also, the United States government is incentivizing organizations to move operations either back into the U.S. or ultimately really just out of China and out of Taiwan. So I think this trend will definitely continue.
Yeah, they're officially our number one trading partner this year, and I don't believe that's going to change anytime soon.
Absolutely. So putting all of kind of these data sets together, so looking at the transportation market, imports, consumer consumption, in inventory, the amount that's coming in, putting all four of these together kind of on one chart, Mike, talk us through some of the biggest takeaways from this one here.
Yeah, I mean, the first one there, the consumer, right? That gray line. Consumption, as we've talked through, is the consumer stayed very resilient throughout this entire period of inflation that they've been dealing with. Looking at it in relation to, I know that unprecedented time of COVID, you saw the consumer behavior change for a little bit, rise as we saw people starting to work remote, and their spending behavior change a little bit more from a non-durable to durable good. Buying desks and doing home renovations, things like that. But as time has progressed, the consumer, for all intents and purposes, in the end of Q2 is still up 2.5% in terms of their behavior. So positive sign that the consumer is staying resilient. As we've kind of already talked through right now, imports we've seen pick up this year. And as of Q2, we saw 5.3% year over year increases in imports. It's another good signal that demand is going to rise in the U.S. truckload market. But the ultimate measurement really is industrial production, right? Industrial production leads to multiple truckloads or LTL movements being needed as raw materials are brought in, things are being manufactured, and then they're ran through distribution channels to retail stores or e-commerce. Right now, industrial production has been relatively flat, and that's the one we're really looking out for to tell us or give us at least a signal that demand is going to start increasing here soon. And then the last piece, of course, and you see that again during the COVID years, inventory to sales ratios drop as more purchasing takes place. It's a good sign to see that inventory levels are starting that direction of deflation, as it leads to potentially more industrial production coming out of that as a result in the future.
Yeah, absolutely. Industrial production has been concerning. More data continues to come out that shows that is slowing. I think that's a big sign as far as possibly heading into a recession for sure. So we'll keep an eye on that one. Now moving to the actual trucking market, let's talk about what's happening with trucking demand. So this is a chart of the outbound tender volume index. So this is not necessarily a measure of how many truckloads are in the market. This is a measure of how many tenders request or truck requests are being sent out, right? So if a shipper has one truckload, maybe they try to go to their primary provider, that guy's not available. They go to the second person, that guy's not available. So that one load now has two tenders. So looking the amount of outbound tender requests that are being sent out over a 5-year period, green line being 2024 again. We are above where we were last year, 2023. We are kind of right in the middle below where we were 2022. This chart's been fairly flat year to date so far. We have increased year over year, but Mike, I would expect this to have been a little bit higher than where we are right now.
Yeah, I mean, especially again, going back to the original conversation about interest rates, right? When you see interest rates being lower, there's, let's say, cheaper capital to invest in inventory level expansion and industrial production. But, this year we've not seen that, right? With interest rates being as high as they are, that excess capital or that interest rate being paid to the business, at least for a lot of the shippers we work with, they haven't been willing to take on that risk. And you see that reflected in the overall demand in the market. Yes, we are above 2023, which is a positive sign. But if you take a look at that 2020 line, when we went into COVID, that was an incredible increase in demand over those months, leading into the back half of 23 in the back half of 20 into 21. That is really what we're on the lookout for in terms of the headwinds of demand, right? Once we start to see industrial production pick up, we should then begin to start to see demand on this OTVI graph start to increase as well.
Absolutely. And Mike, in your opinion, if you were a shipper and you're looking at what's happening in the economy, maybe you've just recently acquired a new business. Maybe you think that your truckload volume is going to increase over the next 12 months. How are you thinking about sourcing a partner? And potentially, do you lock in rates now? Do you wait for the recession? What are your thoughts around timing on that if you're from a shipper standpoint?
Yeah, I mean, every business is going to be a little bit different with the way that they approach those conversations. I think the big thing that a shipper needs to understand is really how the market flips, right? We go from this carrier market to a shipper market, and arguably, we've been in a shipper market where rates have been continuing to push down. But as we lead into the next cycle, as we start to see, potentially demand pick up and really that market flip again into more of a carrier market. It's time to really dust off that shipper of choice strategy, right? They're going to want to take a little bit more time to monitor the performance of their routing guides, right? If you had an RFP that went live earlier this year or even Q2 or Q3, expect some volatility with that routing guide falling through. And we'll see that next and explain that next on the rejections that we see in the market. But, you're going to want to start to prepare to protect yourself from the volatility and the headwinds that we're seeing from a rate change standpoint. If that contracted tender's not committed, not moved with that contracted carrier, obviously it's going to fall into the spot market, which usually leads to a little bit of a higher cost than you plan for with that contracted rate. So usually in these periods, I always suggest that extending or at least redoing your RFPs right before the market changes is always a good strategy. That way that you've got some pretty solid load contracted rates, but you also need to be monitoring the performance of that and working with your partners, right? A good partner is going to work with you through the good times and the bad, and ultimately, for them to stay committed to that business, you need to potentially be flexible with them on that cadence of that RFP, right? We saw a lot of shippers hold rates when rates go up, but when rates go down, they also increase their cadence on their RFPs to doing 3-month or 6-month cycle bids. So, regardless of what strategy you look at, you need to have core metrics to be able to measure the performance of your partners, to be able to have better accountability for that performance.
Yeah, absolutely. And in choosing the right partner, having someone that's going to keep you proactively engaged and letting you know what's to come and using those indicators to forewarn you of what you can expect is of the most importance. And really, the first indicator, Mike, that you and I really look at when speaking with our customers is the outbound rejection rate, right? So at what percentage are tenders being rejected? This is the very first indicator that lets us know what's happening in the market today and what's about to happen in the near future. Rejection rates historically are between that, I'd say 4 to 10% range in a pretty balanced market. Once they get to kind of that 8 to 10% range, that's kind of our first warning sign. And then really anything above 10% rejection rates is pretty full-blown market flip, right? In the carrier's favor. Right now, we're very, very low in the rejections. We've been there for a while, hovering right around 4 to 5% in the recent months. So we are still very, very much in a soft market. The market continues to be in the shipper's favor. But I do think if we continue to lose capacity at a higher rate, we could see rejections start to move. So, Mike, what are your thoughts on where rejections have been so far this year, and where do you think rejections could head the back half of 2024?
Yeah, I mean, no surprise that we're, around or below 5%, right? We've seen rates continue to deflate with, as we've pointed out earlier, a little bit too much supply in the market in relationship to demand. So you see a lot of that, shown here in the rejection rates. What you should expect to see, as you've kind of pointed out, is once those rejection rates start to rise, this is one of our leading indicators to tell us that the market has flipped, has started to flip. And looking at, again, those COVID years from 2020 to 2021, it jumped up between 20 to 25% rejection rates. So that's, 1 in 5, 1 in 4 tenders that are being rejected. And then you're having to go source that capacity then in the spot market at an elevated cost. So as we continue to progress, this is obviously something we're going to be monitoring. But from a shipper standpoint, this should really be an indicator that, again, getting that dust off that shipper of choice playbook and focusing more on the metrics and the performance of your supply chain is going to be integral to your success as we get into this next rate cycle change.
Absolutely. And this is also a great way, if you're a shipper, to benchmark yourself, right? To benchmark your performance. Where are you at compared to your peers in the industry? One good thing about this data is you can also break it apart by state or region or by city, right? So if you have several distribution centers around the nation, you can look at the individual rejection rates, and I don't know, maybe Georgia has a 7% rejection rate, right? So if your rejection rate is at 10% compared to your peers of 7, that can let you know that you're a bit off and maybe you need to rethink your strategy in that certain area of the nation. So rejection rates again, are a great way to benchmark yourself against your peers, not only from a holistic standpoint, but also from a granular level as well.
Absolutely.
Diving into kind of the two different markets in the transportation space, right? So we have the contracted rates that are at the dark blue line, and then we have the spot rates that are the light green line. The split between these two markets is what is the most important piece, not necessarily the actual dollar amount of where they are. You can see before COVID, we're pretty much where we are exactly right now, around a 40-cent split. Obviously, when COVID happened in 2020, people were rushing to the shelves, buying all the supplies. That made contracted rates start to fly. You can see pretty much for almost a year and a half to 2-year period, spot rates and contracted rates climbed together until contracted rates reached right around $3 a mile. So taking a closer look at this chart here, when rates hit that $3 mile for the contracted, pretty much their carriers just said, okay, I'm pretty much going to accept every contracted rate that I can. I'm going to decline every spot market opportunity. That obviously didn't leave a lot of spot freight left on the market for everyone else. So that's when spot rates started to decline during 2022. And pretty much ever since then, we've been around that 40 to 50 cent split. But there has been some recent action. Contracted rates continue to fall slowly, as you can see from 2022. But spot rates have been a little bit more of that volatile marketplace to make that shift. And ultimately, I think the spot market is what's going to drive us into the next market cycle. You can see pretty much the first few months of 2024 was at that $1.50 floor, but we have increased to about $1.73. I do expect that to start to increase a little bit, and I think that leads us into the next market cycle. Mike, looking at this chart, you've been in this market for years now. Your spot market expertise. What do you think is going to happen with this? Not particularly this chart, but this spot market over the next 6 to 12 months.
Yeah, I mean, you hit the nail on the head, first of all. The spot market is the leading indicator for what's going to happen in the contracted market, right? Not to use COVID as a continued example here, because the rate cycle behavior is always the same in previous increases or inflationary and deflationary periods. So, and we'll see that on the next graph too. But, the big thing we call out here is we start to see spot rates rise previous to contract rates rising as well. Usually there's a 3 to 6 month lag for when contracted rates begin to follow that same, behavior. You can see there again, as you pointed out in 2022, spot rates started to decrease heavily as we saw demand fall out and supply stick around, and contracted rates have taken a little bit longer to deflate in comparison to the way the spot market did. So in the future here, that's another indicator of us, aside from rejection rates, how are spot market rates behaving, right? Because that's going to be the indicator that we're going to see next of how RFPs are going to be handled and how they're going to be priced in the near term.
Yeah, so let's move into that, looking at the flow of the cycle, right? So we obviously, history repeats itself. There are trucking market cycles. They're around 2.5 to 3 years. You've got that plotted on here now. Mike, walk us through what's happened during the most recent cycle and what we can expect moving forward.
Yeah. So again, taking COVID aside, because it is a little bit of let's call it an unprecedented time like everyone else has here, we knew in 2020 that we were going to go into inflation regardless. And the big thing to call out about this graph first, and the graphs that you'll see from here on out, is we're taking the actual price of the spot lane or the contracted market, and we're indexing it quarterly or taking a quarterly average, and we're looking at the year over year percentage of change in the rate. Why that's important is because it begins to show a pattern, right? As you kind of pointed out, history doesn't necessarily repeat itself with transportation, but it absolutely rhymes. There's a 3-year period historically where we go through a period of inflation, where we see spot rates rise, contract rates follow, and then they deflate, and then contract rates deflate with it, and then it gets back to that equilibrium, that 0% year-over-year change, right? So when we're looking at the van market too, the reasons why I usually look at the van market first is because, you look at ACT publishes that, in the past 3-4 years, 60% plus of the trailers purchased are dry van trailers, right? It is the most common equipment type that is utilized in the transportation market. So when we're looking at this, we're essentially looking at the historical pattern, right? While this forecast isn't necessarily a crystal ball, it is, if history continues to rhyme, it continues to repeat that same behavior that we see, spot rates are very, very close to equilibrium. There's, as of Q2, we saw negative 1.9% year over year change from Q2 of 2023. And it is really setting the stage for the next rate cycle of rates starting to show year over year increases again.
And Mike, this is specifically, you called out looking at dry van. Next slide, we'll go ahead and look at refrigerated. How much different is this cycle when it comes to the dry van versus the refrigerated market?
Yeah, I mean, the reason why we break this out is obviously very close alignment for most of the time. I think where you start to see deviations to the rate of inflation with reefer in comparison to van is, a good example again is 2020, right? We all got locked down due to COVID, and we saw more durable good purchasing. We saw a lot less the service purchasing, right? A lot, we weren't going out to restaurants as much as we used to. We were buying groceries at home a little bit more often. So we saw consumer behavior change in terms of what we were purchasing, and you can see that reflected in that data. Aside from that, very closely aligned with that behavior, and again, last quarter, negative 9% for dry van, showing negative 2% for the reefer market.
Yeah, absolutely. And there's also a third market here, which usually acts quite different from the first two, right? So dry van and reefer, they're still technically 48 to 53 boxes. There are certain materials that can be hauled on those. But the third market we need to keep an eye on, and a fairly decent size one, is the flatbed market, with construction and housing, and those larger materials. Mike, walk us through how flatbed cycle is looking in the moment.
Yeah, again, all equipment types obviously follow a similar pattern of inflation and deflation. They are very closely aligned with the behavior of the way the transportation market works. But flatbed is the one equipment type that tends to have a beat of its own drum. It is a little bit more deflated, having a little bit less, let's say construction season right now is really leading into that. We've seen PMI not be showing any sort of real industrial manufacturing, industrial production taking place, which definitely leads to flatbed volumes. But to your point about the housing market, the housing market's been relatively down. New single family homes has been decreasing these past couple of months. And you see that in the way the flatbed market's been reacting. Continued deflation in the demand for flatbed commodities being shipped means that we'll see that in the rates as well, as they continue to be a little bit more deflated year over year than where we saw the van and reefer currently.
Yeah, absolutely. And you actually read my mind. So the next data point we have here is the single family housing starts over kind of the last 6 years. And you're exactly right. They have, I wouldn't say fallen off a cliff, but they have dramatically decreased over the last few months here. Is this the biggest factor in the flatbed market? And if I'm a shipper who uses flatbed capacity, how should I be thinking about the back half of 2024?
Yeah, I mean, flatbed primarily, we're talking about construction equipment, right? Or construction materials as well. Again, with housing markets being down, we're seeing a lot less shingles being shipped, a lot less plywood, a lot less lumber, a lot less of a lot of things, right? While we'll still see seasonal upticks in demands here in Q4 with Christmas trees being shipped, it's, from a seasonal standpoint, we're well off into seeing that kind of deflating year over year change with the housing starts, which has led a lot into the demand levels in the flatbed market.
Yeah, and I don't know about you, but there are a ton of neighborhoods going up around me in the Chattanooga, Tennessee area. I'm sure it is like that across the nation. So I do think that there's going to be a ton of inventory on the market. Back to the beginning of the conversation, if the Fed decides to lower rates, I think that might bring a few more buyers into the marketplace, but there are still plenty of houses that are already available on the market that are brand new. So this is definitely keep an eye on this data set moving forward. The last one, Mike, I want to talk about is the dry van. Basically, what we just talked about versus the S&P, so versus the stock market. Walk us through how these two. What's the relationship between these two?
Yeah, it's more of an interesting graph that we were looking at because, the same way that companies look at financial markets is the same way we want to look at the transportation market ultimately. And as you can see there's a pretty good relationship between those two proxies. You see the stock market inflate, you see the stock market change, that's going to lead into hopefully more demand, and then it's going to lead into freight rates increasing ultimately. So as freight rates are a lagging indicator of these U.S. economy points, the big thing to call out here, additionally, is going to be the major weather events, right? We're still here in hurricane season. It could play a role with the change, or at least the way it accelerates into inflation. But ultimately, it's interesting to see that the point of inflation or that point of deflation for the S&P closely aligns within a few quarters with how the freight transportation market rates change as well.
Absolutely. And historically, as you mentioned, it's usually been kind of a perfect storm of events that have taken place within a short amount of time that leads us into that next market cycle. The weather advisory, the NOCC told us that, this year was supposed to be a pretty large hurricane season. Thankfully, we haven't seen, I think there's only been one so far that hit the Texas area that ended up, I think, kind of dying off a little bit. But Luckily, we haven't had that much destruction, but hurricane season is definitely something to keep an eye on, as well as some of the economical changes that are taking effect. So thank you, Mike, for joining us. How can people reach you if they'd like to reach out?
Yeah, you can always reach me by email, mbeckwith@freightplus.io.
Awesome. Thank you, everybody, for joining us for this Freight Plus Q3 trucking market update, and we'll see you on the next one.
Thanks, Tanner.